You've been told that only a fool would pay off debt when they could invest. Every so-called financial expert repeats the same script. Put your money to work, leverage the cheap rates, compound faster. But after 7 decades in the markets, I can tell you this, that advice has quietly destroyed more fortunes than recessions ever did. Wall Street loves to dress leverage in fancy language, capital efficiency, financial engineering, optimized, returns. Behind those polished phrases is the same old game. They profit when you stay borrowed. Your stress, your payments, your endless interest, those are their guaranteed returns. Your risk is their income stream. Now, here's the part they never mention. A dollar of debt repaid is a risk-free dollar earned. There's no market crash that can take it away, no broker collecting a fee on it, no quarterly panic attached to it. Yet this simple truth doesn't sell products, so you'll rarely hear it on CNBC. So before you rush to invest another dollar while still owing one, stop and think. Even the richest investors I've known, yes, billionaires, avoid certain kinds of leverage like a plague. And the reason isn't emotional. It's mathematical. Because once you understand how negative compounding works, you'll realize that paying off debt might just be the best investment decision of your life. Most people don't get trapped by high interest rates. They get trapped by low ones. A credit card charging 18% is obviously bad, so they avoid it. But a mortgage at 3% or a student loan at 5%, that feels harmless. They tell themselves, I can earn 8% in the market, so it's free money. It's not free, it's leverage dressed as logic. Let me show you how this illusion works. Imagine 2 people with the same $100,000. One pays off debt, the other invests while carrying it. The investor feels smarter. His spreadsheet shows an 8% gain and only a 3% cost. But that's a spreadsheet fantasy, not a psychological reality. Every month he watches markets swing while payments never stop. He's compounding wealth on one side and compounding stress on the other. Sooner or later, emotion cancels out math. Meanwhile, the debt-free investor sleeps through the same volatility. He doesn't need to sell in panic because nothing is owed. His lower risk lets him hold longer, which means he actually captures the compounding the leveraged investor only dreams of. Over decades, that calm becomes an edge, a silent dividend, no brokerage statement ever shows. The problem isn't just arithmetic. It's the illusion of rationality, believing that numbers are everything, when human behavior decides who actually keeps the returns. There's a mental model that flips this entire decision, one rule that makes the right choice obvious whether rates are 3% or 13%. I'll explain it soon. Let's talk numbers, not the kind Wall Street sells you, but the kind that quietly decide who ends up rich. Imagine 2 identical investors. Each earns the same income, saves the same amount, and earns the same market return 8% annually. But one carries debt at 6%, while the other doesn't. On paper, that difference seems small, only 2%. In reality, it's the entire game. Because when you owe money, your compounding starts in the negative direction. Every dollar you owe is a dollar that's already working against you 24 hours a day, weekends included. If you invest that dollar instead of repaying it, your gain isn't really 8%, it's 8 minus the guaranteed loss from debt. And because losses compound, just like gains, you're essentially running 2 compounding machines in opposite directions. The engine working for you can't outrun the one working against you. Let's make it concrete. $100,000 at 8% over 20 years grows to about $466,000. But $100,000 of debt at 6% over the same period costs you about $321,000. Subtract the 2, and your net compounding is closer to 3%, not 8%. That's before taxes, fees, and panic decisions. It's financial. Treadmill math, a lot of movement, no real distance. This is what I call the law of negative compounding. Every percentage point of interest working against you cancels more than a percentage point working for you. Why? Because the downside compounds just as relentlessly, but from a smaller, weaker base each year. It erodes faster than gains accumulate. The tragedy is that most investors never see this law in action until they hit a market downturn. That's when they realize the 8% they were earning was never guaranteed, but the 6% they owed absolutely was. There's a smarter rule I've followed my entire life to avoid this trap, one that protects wealth before it's built. I'll share that rule soon. Now that you understand the math, let's talk about why you were never supposed to see it. The entire financial culture depends on one quiet assumption, that you'll keep borrowing, because your debt is someone else's guaranteed income. Banks, brokerages, credit card companies, they've built empires on your willingness to stay slightly underwater. Think about the messages you hear every day. Leverage builds wealth. Debt is a tool. Use other people's money. Those phrases weren't written by philosophers. They were written by people who get paid when you believe them. Here's the truth. You're told to borrow so others can earn. Every time you take on leverage, you become the product. Your payments, your anxiety, your late nights running numbers, that's their cash flow. They get compounding certainty while you get compounding risk. I once knew a professional investor, brilliant man, Ivy League background, managed hundreds of millions. During a bull market, he borrowed cheaply to amplify returns. For a while, it worked until it didn't. When the market corrected, his portfolio dropped 30%, but the bank didn't share the loss. They demanded repayment. He lost tens of millions in a month. That's what leverage does. It magnifies everything except wisdom. Wall Street will always glamorize that risk because it shifts the edge in their favor. They sell the illusion of control, but behind the curtain, the house always wins when you play with borrowed chips. They collect their fees whether you profit or not. And when markets crash, they repossess your chips and move on to the next player. This isn't emotional advice, it's mathematical reality. The system rewards debtors who never learn the math and punishes those who confuse confidence with competence. That's why I never gamble with borrowed money, no matter how low the interest looks. Because the rule I use isn't emotional, it's mathematical, and it never fails. At this point, some of you are thinking, all right, Charlie, but my mortgage is only 3%. My investments make 8%. That's just math. And you're right on paper. It is. But real life doesn't happen on paper. The spreadsheet doesn't know how you feel when markets crash 20%. It doesn't calculate the anxiety of owing money while watching your portfolio fall. It doesn't measure how many nights you stay awake refreshing your brokerage app. That's the invisible cost of leverage, the psychological tax that never appears in your statements, but compounds silently every day. Now, imagine two people again. One owes nothing. The other owes half his portfolio in low-interest debt. The markets turn ugly. Who sells first? Not because they're dumb, but because they're human. The leveraged investor has to sell to meet obligations, to calm fear, to protect liquidity. The debt-free investor doesn't. That difference, the ability to sit still, is worth far more than a few percentage points of theoretical alpha. You see, peace of mind often beats theoretical return. You can't spend potential returns, but you can definitely lose sleep over debt. And here's another thing most people overlook. The moment you pay off debt, you've just earned a guaranteed risk-free return equal to that interest rate forever. No volatility, no fees, no luck required. That's a return even Wall Street can't sell. People love to complicate this debate. They say, but the stock market averages 10% a year. Yes, averages. In between those averages are brutal drawdowns where emotional decisions erase years of compounding. Debt doesn't average, it compounds relentlessly without mood swings or mercy. So before you chase theoretical gains, ask yourself, would you rather be rich on paper or secure in reality? Now, to be fair, there is one rare situation where investing first does make sense, but only one. And that's when the math, the psychology, and the time horizon all line up perfectly. I'll explain it soon. Now let's bring everything together, the math, the psychology, and the truth that ties them both. For 70 years, I've lived by one rule in investing and in life. Eliminate the downside before you chase the upside. Because wealth isn't built by maximizing gains. It's built by minimizing ruin. Every financial decision you make, whether it's taking on a loan, buying a stock, or starting a business, has two invisible forces acting on it. One is gravity, the other is lift. Your investments provide lift, they push you upward through time. But your debts create gravity, they pull you down every single day. Most people never see this law at work because the pull is slow. But over decades, even a little financial gravity compounds into a crushing weight. That's why I call it the law of financial gravity. Every debt creates drag that compounds against your freedom. Imagine a sailboat trying to cross an ocean. You can add a bigger sail, a better compass, and a stronger engine. That's your investing strategy. But if there's a hole in the hull, it doesn't matter how fancy the equipment is. You'll sink long before you reach the other side. The smart captain doesn't obsess over speed. He patches the hole first. Most investors do the opposite. They chase wind and technology, the next stock tip, the next strategy, while quietly leaking wealth through fees, interest, and debt. They're proud of their high-performance sail, never realizing their boat is taking on water. I learned this lesson early in life. The goal isn't to be brilliant, it's to avoid stupidity. And borrowing money to chase higher returns is stupidity disguised as ambition. The paradox is that safety compounds faster than risk. When you remove threats to survival, financial, emotional, or behavioral, the compounding that remains accelerates naturally. That's what Buffett and I have done our entire lives. Limit the downside so ruthlessly that the upside takes care of itself. Think about it like this. The investor who earns 10% with no debt and never sells will beat the leveraged investor who sometimes earns 20% but occasionally loses 40%. Because compounding punishes volatility. Every drawdown is a tax on future growth, and debt multiplies that tax. When you're debt-free, every gain is permanent. When you're leveraged, every gain is temporary, waiting for the next margin call to take it back. So what's the mental model? It's inversion. Ask not how much can I make, but how much can I lose and still survive? If the answer is too much, the correct action is not to optimize, it's to simplify. And simplicity, my friend, is the ultimate sophistication in finance. You don't need exotic strategies. You need insulation from stupidity. You don't need a genius IQ, you need a margin of safety. You don't need excitement, you need endurance. Once you internalize this, every decision becomes clearer. Should you invest or pay off debt? Invert the question, which path minimizes your chance of permanent loss? That's your answer. Now, you might be wondering how I've applied this rule in my own life, not in theory, but in practice. In a moment, I'll show you exactly how I've used this principle to make every major financial decision, from real estate to stock investing to personal debt, and why it's kept me solvent, calm, and wealthier than any gambler chasing alpha. I didn't learn this lesson in a classroom. I learned it by watching smart men destroy themselves with borrowed money. When I was young, I thought leverage was a tool for intelligent people, that if you were rational enough, disciplined enough, you could handle it. Then I watched the smartest man I knew lose everything in 6 months. He was a lawyer, older than me, brilliant with numbers. In the 1,950 seconds, he borrowed heavily to buy stocks he was sure were undervalued. For a while, he looked like a genius. His returns doubled. His confidence tripled. Then the market turned. The same leverage that had made him rich made him desperate. He sold everything at the bottom to cover margin calls. And by the time prices recovered, his capital was gone. He never recovered emotionally either. That was the day I realized that intelligence is no protection from leverage, only humility is. Years later, Warren, and I used to talk about this often, he'd say, "Charlie, if you're smart, you don't need leverage. And if you're dumb, you have no business using it." He was right. We built Berkshire Hathaway on that foundation. No unnecessary debt, no borrowed emotion. That's why when markets crashed, 1,973, 1,987, 2008, we didn't panic. We weren't swimming naked when the tide went out. People often think discipline means restraint. It doesn't. Discipline means clarity, knowing which risks aren't worth taking, even when they look clever. And debt almost always looks clever right before it destroys someone. The older you get, the more you realize that safety compounds. It's not flashy. It doesn't make headlines. But the quiet compounding of safety, year after year of not making big mistakes, outperforms every thrill seeker chasing the next big win. I once met an old investor who lived through the Great Depression. He told me, "Charlie, I never borrowed again after 1932. Not once." He died in his 90s with more wealth than he could ever spend and not a day of financial anxiety. That's what peace looks like when it compounds for a lifetime. Now, to be clear, I'm not saying debt is always evil. There are rare moments, very rare, when it can be used wisely, but only if you understand its true nature, not as a shortcut to wealth, but as a magnifier of risk. In a moment, I'll show you exactly how to think about those rare cases, the only times when borrowing can actually serve you, not destroy you. Let's look at the three great lies that keep people poor, anxious, and confused, lies so common that even intelligent people repeat them without realizing they're traps. Because most people don't lose money through stupidity. They lose it through accepted myths. Good debt builds wealth. That phrase has destroyed more balance sheets than recessions. Debt doesn't care whether you call it good or bad. It compounds just the same. The only thing good about it is how good it sounds to the person selling it to you. They'll say, "Borrow for real estate. It's leverage. Use debt to grow your business." That's how rich people do it. What they don't tell you is that the rich use debt as a tool of timing, not as a habit of life. They borrow with liquidity, patience, and exit plans, not to fund lifestyle, inflation, or speculation. I've seen entrepreneurs take on business loans during boom years only to fold when revenue drops 15%. The interest clock doesn't stop ticking just because your income does. Debt demands consistency from an economy that never provides it. That's why I tell people, the fastest way to go broke is to borrow your way to prosperity. Low interest debt is harmless. This one's particularly dangerous because it sounds reasonable. People justify keeping debt because the rate is only 3%. But 3% guaranteed against you is still a guaranteed loss. And the loss is psychological as much as it is financial. There's a behavioral study I once read. They tracked hundreds of investors with small, low-interest loans. The ones who became debt-free early outperformed the rest by nearly 30% over the next decade, not because their investments were smarter, but because their behavior was calmer. They saved more consistently, they traded less, and they didn't panic during downturns. That's the hidden math. Debt amplifies volatility. It doesn't have to bankrupt you to weaken your compounding. It simply keeps you anxious enough to interrupt your own progress. Now, take the average mortgage example. Say you owe $400,000 at 3.5%. That's about $14,000 a year in interest. If you prepay even an extra $10,000 annually, you're locking in a guaranteed tax-free return of 3.5%. You won't find a single bond or fund that promises that with zero risk and zero sleepless nights. Low interest only sounds low when you ignore how long it lasts. 30 years of just 3% is still a lifetime of drag. You'll miss market gains if you pay off first. This myth thrives on fear, the fear of missing out on the next big run. But markets don't reward urgency. They reward endurance. I've seen this play out for decades. People rush to invest while juggling debt, convinced they're being clever. Then a correction hits. Their investments drop 20%, their debt stays at 100%, and suddenly they're forced to sell at the worst possible time. Meanwhile, the person who spent those same years paying off debt quietly built a foundation of calm. When the market crashed, they didn't have to sell, they bought. That's the irony. The debt-free investor has the most courage when courage is most rewarded, because freedom from obligation is freedom from panic. Let's quantify it. If you carry $50,000 of student loans at 6%, you're losing $3,000 a year in guaranteed costs. If you pay it off and redirect that same cash flow into investments, you're now compounding from a clean base, no drag, no anxiety, no divided returns. That's like starting a race without weights around your ankles. The truth is, the best investors don't chase every opportunity, they wait for the few that matter. And you can't wait patiently when your wallet owes someone else. The pattern is clear. These lies persist because they're profitable to someone else. Each one keeps you participating in a system that extracts from your effort and sells you comfort in return. You don't need comfort, you need clarity. In the next part, I'll show you how to use that clarity to build a simple, step-by-step playbook that tells you exactly when to pay off, when to invest, and how to stay free for life. So far, we've talked about principles, how leverage traps you, how math deceives you, and how simplicity compounds faster than complexity. Now let's turn those principles into something you can actually use, because in the end, clarity beats intelligence. Your best investment isn't in a stock or a fund, it's in a system that removes indecision forever. I call it the Rational Freedom Framework. It's a simple 4-step playbook to decide, once and for all, whether to pay off debt or invest first. Step 1, pay off all high-interest debt immediately is greater than 7%. Anything above 7% interest is not a loan. It's legalized wealth destruction. You can't out-invest that mathematically, consistently, or emotionally. Credit cards, personal loans, auto loans, some student loans, these are your financial cancer. Every dollar you pay down is a guaranteed risk-free return. If you repay a 10% debt, you've just earned a 10% return, locked in, tax-free, and permanent. That's your highest ROI investment, period. And if anyone tells you to leverage cheap money while carrying 18% debt, smile politely and ignore them. They're playing for the house, not for you. Step 2, automate investments while paying off low-interest debt is less than 5%. Once the bleeding stops, balance begins. If your only debts are under 5%, such as a mortgage or student loan, it's not about elimination, it's about automation. You don't need to choose between paying off debt or investing. You do both, mechanically. Set up automatic contributions to a low-cost index fund, ideally 15-20% of your income, while making consistent, slightly accelerated payments on that low-interest debt. This keeps your compounding engine running without emotional strain. It's not about optimizing returns, it's about building habits that run without willpower. Because the less you think, the more consistent you become, and compounding only. Rewards consistency. Step 3, eliminate all non-productive leverage. There's a kind of debt that isn't measured in interest, it's measured in distraction. Margin loans, unnecessary mortgages, speculative business debt, these are the invisible chains that keep investors anxious. Non-productive leverage is anything that creates risk without creating value. It may look harmless when times are good, but when the wind changes, it's the first thing that sinks your ship. Cut it. Free your attention. The peace of mind you gain will make you a better decision maker, and better decisions compound faster than borrowed money ever will. Remember, safety doesn't slow compounding, it protects it. Step 4, sleep better, live simpler. This is the dividend that never shows up in your portfolio reports. the ability to sleep soundly at night, knowing no one owns a claim on your next paycheck. A clear financial life creates a clear mental life. When you stop juggling interest rates, payments, and projections, you regain the one resource that outperforms all others' focus. The truth is, most people don't want wealth, they want peace. But peace can't exist in debt. You can't meditate your way out of monthly obligations. You can only pay your way out. Once you remove financial gravity, every other part of life lifts with it: relationships, creativity, health. You make better choices not because you became smarter, but because you stopped being scared. That's the hidden ROI of simplicity. It compounds not just in dollars, but in decisions. Now, let me give you the final principle, the one that permanently changes how you define wealth. Because true wealth isn't measured in assets or income. It's measured in how little you owe, how little you need, and how calm you feel when markets burn. And that's what will end with a complete redefinition of wealth itself. We spend our lives chasing wealth, but very few people ever stop to ask what wealth actually is. They think it's a number, a portfolio size, a trophy balance on a brokerage screen. It isn't. Wealth is the absence of worry. It's waking up without anxiety about the next payment, the next bill, or the next market headline. It's knowing that no one owns a piece of your future. Freedom isn't having money, it's never needing to owe. That's the quiet truth that gets drowned out in a world obsessed with leverage, scale, and maximizing returns. Real wealth isn't loud. It doesn't need to prove anything. It's invisible, like the confidence of a man who owes nothing and fears nothing. If you want to feel rich, pay off every dollar that weighs on your mind. If you want to stay rich, stop believing that complexity will save you. Complexity feeds the ego. Simplicity feeds the soul. The irony is that the richest people I've ever met aren't the ones who took the biggest risks. They're the ones who made the fewest mistakes. They didn't gamble. They didn't chase. They didn't borrow against their future to impress the present. They played the long game with discipline and humility, and that's what made them unstoppable. That's why Buffett and I always said, avoid stupidity before you chase brilliance, because brilliance is rare, but stupidity is everywhere. And the easiest way to stay ahead in life is to stop giving stupidity an interest rate. You don't need to outthink the world. You just need to stop letting the world rent space in your mind. Once you live without debt, without dependence, and without fear, you've already won the game. So as you move forward, remember this. Every time you eliminate an obligation, you reclaim a piece of your freedom. Every time you simplify your finances, you sharpen your focus. And every time you resist the temptation to optimize, you build endurance, the kind that lasts decades, not quarters. That's the real compounding. Not money growing faster, but you growing calmer. Wealth is peace. Wealth is clarity. Wealth is the ability to say no and mean it. And that's the kind of wealth no market crash can ever take away.